Good morning, everyone. Sorry for the few minutes delay, but getting everything set up here. I hope you can all hear me. My name is Joan Popolo, and I'm the Executive Director of Action Innovation Network. Action is a collaborative network of technology business incubators throughout the greater Boston and New England region. And our incubators are supporting companies with technologies in the life sciences, clean tech, robotics, advanced materials, and ocean and maritime. We provide a suite of resources for international startups that are looking to explore Boston and its innovation ecosystem as a place to grow their businesses, and many of our webinars are focused on this area. I just want to start with a few quick items this morning. As housekeeping items, all of the attendees will have their audio and video off this morning. We're going to dedicate 45 minutes to this presentation with about 15 minutes at the end to answer any of your questions. I hope you're all aware that you can use a chat box here to put your questions in, and we will address those at the end of the presentation. We're also going to be recording this webinar and have it posted on our website for later viewing if you want to look at it again. It'll also be sent to you in a follow-up email. So with that, today's webinar is Startup Innovation Funding, R&D Tax Credit. It will have multiple presenters this morning from Layton. We have Tom McDaniel, who's Senior Vice President, Craig Hale, Senior Vice President and PhD in Aerospace Engineering, and David Roberson, Senior Tax Attorney, all with Layton. They can all speak to the challenges of building a U.S. office from the ground up, as well as advise on tax credit strategies for you. Layton is a global R&D tax credit consulting firm, and their team of highly experienced scientists, engineers, tax consultants, and tax attorneys implement strategies to claim the R&D tax credit, ensuring maximum eligible financial return without impacting a company's core business. So with that, I'm going to hand it off to David to start the presentation.
Good morning, everybody. Thanks for joining us this morning. I'm looking forward to giving you guys a rundown of sort of the transitions from international aspects to domestic aspects, at least here in the U.S. I know that Tom and Craig have had a lot of challenges and overcome those challenges in moving Layton into the U.S. And I'm happy to be a part of it as well. And I'll be going into more detail on the R&D tax credit and how it can affect your business operations and how it can be an additional source of cash flow. With that being said, I'm going to turn it over to Craig and Tom to give a little insight into their experiences as to coming over from the UK to America.
Thanks, David. Yeah, so as David alluded to, I think we wanted to talk a little bit around the I guess our entry into the US market, to give you some insight into how we found it, some potential insights and tips that we have kind of learned at the time, and I guess in hindsight would have been good to know when we started, as well as obviously handing over to David to talk more through the R&D tax credit. In terms of Layton as a group, so we've had a lot of experience in international expansion. We started in France back in 1997. And as you can see from the slides, we're now in 11 different countries. So we were fairly well set up to open an office in the US. We could leverage good experience to be able to know how best to approach it. So Layton has been doing that year on year and growing. And obviously we're around about 1,500 employees now across the group. In terms of the US, we opened our office in February 2018. So we've been going now just shy of 2.5 years. And it was all based around the credit. And the US for a very long time had a temporary R&D credit that would get extended every 1 or 2 years. And so it was seen as quite a risk to open an R&D tax business when the credit was not permanent. So as soon as that was made permanent and there was some better offerings for early stage and younger companies, we took the plunge into the US and started with six employees to begin with. Since then, in that time, over the last 2 years or so, we've grown the company now. We're now just over 80 employees, and we also opened a second location on the West Coast in San Francisco. So a very different looking business to what we were in February in 2018. So it's been a very exciting and challenging time for us, for sure. Next slide, David.
Yep.
So we thought it'd be useful between Craig and I to talk a little bit around some of the things that we found really useful when launching a US business. I had personally had no experience prior to doing this of opening a business in the UK, let alone doing on overseas. So I was really learning on the job, but there were some really important things that I learned along the way, which I want to share with you. A lot of people talk about the US in terms of having a good professional network. When I spoke to people, that was kind of their number one advice across the board, is that it's a very network driven environment and country. And that helps with two things. It's the acquisition of clients, but also finding good vendors in the market. It's incredibly time consuming to go around. So if you're looking for a lawyer, if you're looking for a recruitment agency, doing that from scratch from Google. If you can quickly build good relationships with trustworthy people within that local network, it makes a huge difference. And a lot of the vendors that we used to launch the US were recommendations of people that I built up relationships with in the kind of 1 or 2 years preceding opening the office. So it's absolutely imperative that you work on building that network, get to know people within the city or the state that you're looking to open an office in, and essentially get that trustworthy advice in terms of what, who's best to use, who do they recommend you using to help with your needs. We also got a lot of our initial clients from introductions from that network. So it was a kind of strange situation. I was being introduced to these companies who probably didn't know that we'd only been in the US for 1 or 2 months, but because I built up a good relationship with some of the people in my network, they were giving me a very positive recommendation and that we should use Leighton, that I was a good person, reputable, and all that good stuff. And so we got a lot of clients on board through those recommendations, and that was incredibly important because the process of getting up to speed on kind of just new business only, cold calling, networking, and everything else, does take time. So to have those initial introductions was of massive importance to kind of get us up and running and get those initial clients over the line. Visas were also a bit of a sore spot. We didn't give ourselves nearly enough time to get them through and approved, and so it's massively important get a good visa lawyer or to lined up. You need to understand what visa you're going for, and typically, mine took about 6 months in total, and I didn't give myself nearly enough time. So there was kind of a very tense moment between kickstarting the US office and getting that visa approved. And I wish I'd given myself a lot more time to go through that process. They're very, very documentation heavy. They don't always get approved straight away, so you might have to do a kind of bit of a rejig and reapplication. So there's a lot of things to take into consideration. So getting those visas, depending on if you're coming over here or if you're bringing employees over from another country, that's massively important. Get a very good immigration lawyer lined up for that process. And understand the US market. It's a pretty obvious one, but I don't think I went into enough detail when we kickstarted the office here in the US. I think I spoke to a lot of our competitors. We got a lot of information from them in terms of high-level product information, but I should have really gone more granular in terms of their full business process, all the way from what markets do they target, how do they actually go through the process and deliver their service, and then importantly on the back end as well, invoicing and cash collection. Understanding the full process of how that business runs would have been very useful. And we've done that through a bit of kind of mystery shopping, as we call it, building some relationships within that industry. But we've been learning that as we go over the last 2 years. And if we could have that information from day dot, that would have been a massive help for us to better understand how we build this business and how we build the service. So really understanding the competitors and getting some time on the phone with them, getting some really key information from them is so important before landing in the US. So I think for me, those are the big takeaways that I would say would have made, also they made a big difference and would have made a big difference in hindsight. I'll kind of hand over to Craig now to talk a little bit more about the post office running, but those certainly getting the business up and running, those were the key aspects.
Thanks, Tom. Good morning, everyone, and thank you for joining us this morning. I'm Craig. I'm also SVP at Leighton USA. So my core responsibilities, as well as helping Tom to run the business, is on the technical delivery side. So we very much need good employees to be part of our team to help us grow our business and to service our clients correctly and help them with their R&D tax credits. So one of the key things that I've found since we started in the US is that, especially being in Boston, where the job market's very strong, is that you really need to understand that employment landscape and what the job market is like, where you're hoping to open up an office. We found that you need to make sure your benefits package is incredibly competitive, much more so than you would typically expect in the UK. And then simple things such as where you're going to locate the office. Is it close to transportation links? Can people actually make it in there okay? Is it in a nice area? Lots of these things are quite important to the people you want to bring on board. And if you are a people business and you're looking to grow the team, there are lots of things like that you need to take into account. To the extent that we were told by one of our employees after being with us for about a year that if our office was basically across the road, then that would have been slightly outside of their boundaries because it was too far of a commute from the commuter rail. So it's little things like that you need to sort of appreciate when starting an office in the US. The other thing that's really important, and more so for Tom and I coming from the UK, is that the UK is obviously one country, and the US you kind of look at as one big country. And of course it is, and there's that scale which you can take advantage of. But how we sort of like to look at it is almost 50 countries, all with their slight nuances in terms of how to approach the market, how people in those states like to how to communicate with you. All these sorts of things need to be taken into account to make sure that you are able to properly leverage the market. So being aware of local nuances really helps you to maximize and take full advantage of that scale. So things we've put in place around those aspects have really helped us to grow, and we're starting to reap the rewards from that now. Thank you, and I'll hand you over to David, who's one of my senior tax attorneys.
Good morning. Thanks, Craig and Tom. Appreciate the perspective on that. Obviously, as you can tell by my accent, I'm not from the UK, but I was brought on as part of sort of relatively early on in Leighton's career here in the US, or tenure in the US. And my background, I've been practicing law for about 10 years. I've been specializing in the R&D tax credit, which is what we're about to discuss here, for the past 6. I've worked for some of the bigger names in the industry, including being a manager at KPMG in their New York office. And then when Craig and Tom were looking for somebody to kind of bring some experience to the table and help things get started, I was happy to move to Boston and join the team. But the R&D tax credits is a very interesting and niche aspect of the U.S. tax code, and not many people know about it. Honestly, I mean, the last statistics that were show that about 65% of American businesses that are eligible are unaware that this credit exists. And this credit's been around since 1981. It's not something that's just fresh out of the gate right now. It's something that's been around for a long time. And it's something that has been part and parcel of the code. And not only that, it's been litigated, it's been audited, it's been sorted through. So the rules are pretty well known. The boundaries are well known, and it's something that is now, as Tom mentioned at the outset, which is what motivated Leighton to actually come to the U.S. It's now permanent. Before it used to be every 2 years Congress would have to decide to re-up it and to bring it back, essentially almost retroactively. And of course, that was always a tight experience for everyone at December. Are we going to have a job? At least in my industry, are we going to have a job next year, right? And then finally in 2015, as Craig mentioned, as Tom mentioned, they made it permanent. And the benefit of that is it now can be part of your planning on a year-to-year basis. But they also, not only did they make it permanent, but they also expanded it. And we'll go into that in just a second here. But first off, an introduction to the credit. A credit is different from a deduction. A credit is a dollar-for-dollar reduction in your tax liability, right? And so it's much more valuable. It's much more beneficial to you when you're in a situation where you're becoming profitable, or where you're having income and you're running afoul, if you will, of tax liability, right? The benefit to it is one, you can claim it in the current year, but 2, you can also claim it retroactively for 3 years. So that means if you were profitable in prior years, you've essentially overpaid taxes, right? And so when you actually amend those returns and submit that credit, that's cash money in your hand. You know, the response from the government is a check to you. You can use that for vacations. You can use that for reinvesting in your business, which, you know, we would recommend. But essentially, it's cash money that essentially you've overpaid, and you're due a refund. So that's always a good thing to look at, especially if you've been paying taxes over the past 3 years. Additionally, the R&D tax credit has been so popular on the federal level and so effective on the federal level that many states, it's actually 38 states itself, have their own version of the R&D tax credit. Some of them are more lucrative than the federal credit. Some of them are less. Massachusetts has one, just speaking from our location. California has one. And the interesting thing about that is that it uses the same set of costs as the federal ones. There's not an additional analysis. There's not an additional concern. There are some different calculations that are applicable, but that's what Layton's here for. But the point there is you can get not only a tax credit on your federal level, but also on your state level. So that's a really good benefit to imagine, because as Craig mentioned, it's not only is it one large country, but it's also 50 smaller countries. So we have the scenario of both things and both tax jurisdictions being applicable, right? So in 2015, when they made it permanent, they also added the payroll tax credit, which is very, very important and very, very key for, especially for startup folks. The payroll tax credit is a tax credit that's derived from the R&D tax credit. It is a subset, if you will. And what it does is it allows you to, if you're not incurring state or federal tax liability, you're still going to have to pay taxes on payroll for your people, right? And obviously, as Craig mentioned, a lot of companies are people companies. They're based on who is doing the work. Why are these personalities or these particular skill sets effective, right? And with that being said, especially in your tech companies or your biotech initiatives, you're going to have to find the right people, and the right people are going to cost money, right? And when you're talking about payroll, you're going to have to pay a percentage of your entire payroll to the government as a payroll tax. And so what this addition to the R&D tax credit allows you to do is take that R&D tax credit money that you have that normally would have been reserved for income tax liability, and apply that to your payroll tax liability on a monthly or biweekly basis, depending on how you run your payroll tax credit. This is beneficial because a lot of times you're not going to be profitable right at the outset. You're not going to have any income tax liability, but you are going to be paying payroll taxes just to keep your folks on payroll. So that was a game-changing addition to the R&D tax credit. It still is a dollar for dollar reduction. And the other nice thing is if you generate the credit, it doesn't expire. You can use it indefinitely until you've exhausted. One difference between between the payroll tax credit and the basic R&D credit is that the payroll tax credit can only be claimed in the current year. So there's no retroactive review. So it's sort of designed to be a real-time analysis of if you're investing this money into your people, you should get this money back. That's essentially the function of it. So it's only going to be good for you can only claim it in your current year. You can claim it additionally in additional years, and we'll go into more detail on that in a second. But I just want to make that clarification between the retroactive piece of the of the R&D credit versus the current year aspect of the payroll tax credit. So as far as a higher level overview for the R&D credit, as I mentioned, it can reduce payroll and or income tax liability depending on your situation. If you're eligible, you can actually do both, but it depends on where your pain points are and where your tax liability actually is, right? One of the biggest things here is you'll see a lot of cash flow options in the startup world result in sort of giving away part of your company, whether it's an angel investor, a venture capitalist, what have you. They're generally offering X number of dollars for X number of percentage of your company, right? Whereas this credit is actually generated by your activities. It's generated by what you're doing, and it's essentially recycling your money. Now, that's one way to look at it. Additionally, let's say you have already taken advantage of an angel, or not taken advantage, you've already been benefited by an angel investor, or entered into agreement with a venture capitalist. One of the things that I've always advised my clients on is, if you're doing this R&D credit and you're using it to reduce your payroll taxes, to reduce your operating costs, that's a feather in your cap. That's something to say to your angel investor or your venture capitalist. Look, not only do I have this great idea, not only do I have these great people, but I'm also being economically responsible with it. Look, I'm going to be taking care of your money because I care, right? That's going to make every angel investor, that's going to make every venture capitalist much more pleased with the whole scenario. So that's something, a little nuance to add to it here. And Craig and Tom can maybe speak to this a little bit, but I know that globally there is almost every developing country or developed country has some form of the R&D tax credit, and the goal of these incentives worldwide is to kind of influence and incentivize people developing new processes, new products, new designs. I don't know, Craig, do you want to speak to the UK credit at all here?
Yeah, so as a group, obviously we're based in lots of countries around Europe, Canada, and the US, helping companies with the R&D credits in those respective jurisdictions. And every credit is built upon the same principles. And lots of people do find it a bit odd, the tax system's giving money back, or they're reducing how much tax we pay. But when you look at the big picture, it's quite straightforward. And this is why every country has embraced it, and then year on year, over time, it basically gets more lucrative. And that's essentially the credit you get back now, the reduction in tax liability, is almost like a seed that the government's planting. And they hope that seed then turns into a lot more tax for them in the long run. So because they're incentivizing specific behaviors, they want you to do more R&D in their country. They want you to contribute to the economy by employing more people, by creating innovative products, so then your profits go through that country. Or they want you to upskill your workforce, so you're starting to employ highly educated, highly qualified people who in turn cost more money. So they're hoping to get more income tax from the business, they're hoping to get more income tax from the employees, they're hoping that they increase the spending power within the country due to all those people hoping to charge that, and then they got all the local taxes in those countries. So in the long run and over time, each government in those countries will actually generate more credits. And more taxes, which is obviously what the whole purpose of it is. And looking at the group, all the countries have slightly different takes on the R&D tax credit. So just quickly touch upon the UK. The credit there is sort of two different types. You have a large business credit, which is percentage-wise similar to the return in the US. But you do get it back as sort of above the line income. So it makes it quite attractive to large businesses for the UK. And then smaller businesses, they can actually make it refundable if they sacrifice the rate at which they get it back. So they get a lower rate, but they get it as cash rather than a reduction in tax liability. In that UK credit has evolved over time to reach that point. And the US credit, with the introduction of the payroll credit, and looking at some legislation that's up and coming, is also looking to evolve as well. So it kind of lends itself to globally, this type of credit really does work, and it really is a massive contributor to the economy.
Yeah, and Craig, thanks for that. And to Craig's point as to the increase of economic production and jobs, the latest statistics show that for every dollar of tax credit that is offered by the IRS or by the U.S. Treasury, it actually generates almost $4 of economic growth. So it is something that makes sense for everybody, not only for businesses, but it also makes sense for the government and even the IRS, which is when you find a win-win like that in tax, it's always a beneficial option to take advantage of. Let's see here. All right, so going back to the U.S. version, thanks, Craig, for the UK breakdown. The U.S. version centers around what we call the four-part test, right? And this has essentially been the standard since 1981, and it continues to be the standard. And what happens with the four-part test is you start off with a new or improved business component. This is IRS language, and I'll do my best to translate this as we go along. but a new or improved business component. And that can be a product, a process, a technique, a formula, a software, basically something that is either held for sale, lease, or license in the course and scope of your business, or as a tool that you're going to incorporate into your business operations in some form or fashion, right? Let's see, it's either something you're selling, leasing, or licensing, or something that is helping your business become better, right? And this can be new or improved. This can be brand new. It can be patentable. It can be something that is, just groundbreaking, or it can be something that's new to you, something that you've developed. Maybe you've relied on previous principles. You've relied on certain ideas. Something's triggered you to develop either this aspect or this functionality, or it can be something that's improved, something that you've already been using, or something that somebody else has been using, and you're taking it. You're putting your spin on it. You're adding functionality. You're adding efficiencies, and you're making it better. So all of those things can be combined into this new or improved delineation, right? The other thing to notice there is that they do ask you to have some sort of they call it a permitted purpose, and what that means is you're looking at a situation where you're taking this new or improved product or process or software, and you're improving something measurable about it. You're not just changing it from blue to red, pink to blue. You're changing it from you're adding functionality to it. You're changing a piece of it of the process that makes your process more efficient, that increases throughput, that increases output. You're developing a formula which is more efficient. You're developing a formula which is more effective. There's more of an active ingredient. There's more of an effect on the overall piece there. So that's something to bear in mind as well. It's not just style or taste or cosmetic changes. It's measurable changes that affect the functionality or efficiency or quality or reliability of the product or the process, right? And so that's all well and good. Well, how do you go about doing this? How do you go about developing this improved product or process? Well, that brings us to the second part, right? That means there's some uncertainty about this. There's some uncertainty about how do I do this? What's going to be my process? What's going to be my step 1 versus my step 10? What's going to be the best order of those 10 steps in my process? How am I going to make this thing work, right? So the second part of the test is that there is some uncertainty overall as to your product, your process, your software. You're unsure about it, right? And it doesn't, everyone's experts in their field. You don't have to be, blind and just, grasping about for clues. But there is, and you might even know the parameters. You might even know the end goal of what you're looking for. But ultimately here, there is some uncertainty in the overall process or in the overall product design that you have to overcome, right? And how do we overcome that? Well, we overcome that by the third step in the 4-part test, and that's a process of experimentation where alternatives are evaluated. Now, when you hear process of experimentation, a lot of folks think scientists and lab coats, and while that definitely is R&D, it's not required to be like scientific beakers and what have you. The key language here from the regulations from the IRS is that there's evaluation of alternatives. It's systematic. You're not just throwing darts at a wall, but there's a systematic approach to overcoming that uncertainty, overcoming the challenges, the roadblocks to development, to ultimate delivery of a product that functions and that you're proud of, right? So there's a systematic approach of evaluating alternatives, and that can be a variety of things. But the point is, you try different things to solve the problem, right? And then ultimately, the fourth part of the test is that there's principles of the hard sciences being applied here. The IRS calls this technological in nature. And again, this is not referring necessarily to biotech or scientists or software, but it refers to the fact that you're using hard science principles to underpin it. You're not using political science studies. You're not using surveys. You're not using opinion pieces. You're using principles of biology, chemistry, physics, engineering, computer software, et cetera, et cetera. You're using principles of the hard sciences. So ultimately, you're using principles of the hard sciences to underpin that process of experimentation to allow you to evaluate different alternatives, different means and methods of achieving your goal in order to overcome that uncertainty and ultimately deliver a newer improved product, that process, incorporate that process into your production line, et cetera. So that's the 4-part test in sort of in a nutshell. Obviously, there's a lot of nuances and a lot of details which we can go into later time, but that's it in a nutshell, right? Now, you might think this is very vague, and it is. It's designed to be that way. It was designed by the Congress to be very broad and very inclusive. And the reason for that is because there are so many different types of industries in America. And once again, it's a big country with a lot of diversity, that the government wanted this thing to be as applicable, as expansive, and as inclusive as possible. And so we look at eligible industries. These are some that that Leighton works with on a regular basis. I've worked with personally with something in all of these categories. But if you look at it, you're talking about everything from construction to engineering. You're talking about Craig's favorite, aerospace engineering. You're talking about pharmaceuticals and food and beverage science. For example, one of my favorite categories to work on is craft breweries. And you might say, David, how does craft breweries work? Well, guess what? Every time they make a new recipe, they're developing a recipe that uses biochemistry. They're using principles of food sciences, sensory sciences, and they're using different pieces to go into a boiler and create a new beverage. And sometimes it works and sometimes it doesn't, right? And the interesting thing about that is that there's over 8,000 different craft breweries in America right now, right? And I would say less than 25% of them are aware of this R&D tax credit. But then you have everything that you might expect as well. Software, your fintech apps, your development of machine learning, AI, right? SATCOM, all these sorts of things. So essentially, there's very few industries that don't qualify. Obviously, you want to make sure that you meet the 4-part test, and that's what Leighton is here for as a consultative firm. But ultimately, this thing is so broad and so inclusive that it really behooves you to evaluate your operations, what you're doing, and understand that there's a good chance that you fit into this mold, right? It's like I said, I can't stress enough. It is very expansive. So the question then is, okay, this 4-part test is all well and good, and that it sounds kind of theoretical. How do I make this into money, right? Well, and the answer there is not only do you qualify the activities through the 4-part test, but then you qualify the costs. And the cost categories there's four cost categories that are applicable, that are eligible, if you will, for the R&D tax credit. Starts out with those salaries and wages. This can include compensation of officers as well, provided that the officers are in fact involved in the overall process. And you notice there's three adjective phrases that are described as salary. 1, directly involved; 2, directly supporting; and 3, directly supervising, right? And so that means that you have folks that are, let's say that there's a CEO, there's an engineer, and there's a junior tech. The CEO still is hands-on, so she's going to have some aspects of the overall business that that she's involved in. But she's also going to have some admin. Directly involved, there's going to be an engineer that's going to be pretty heavy into it. He's going to be working hard on a regular basis, kind of all day, every day, to make this thing happen. But of course, there's going to be things that he's going to need help with, so he's going to hire, or the CEO is going to hire, someone to support that character, right? That engineer. Those are going to be in a direct support role, doing the things that maybe the engineer just needs help with, right? And so you have people that are directly involved, people that are directly supporting, and then you have people that are directly supervising. The CEO is going to talk to that engineer. She's going to say, hey, Bob, how are we doing on this development, this piece and that piece? And well, they're going to be a team. They're going to be all connected with a nexus to the activities that are involved, right? And so in this instance, you're looking at all those people have some level of involvement with the R&D activities. And with that being said, you get to claim a percentage of those salaries. You get to claim however much time those people spend on the project, the R&D work, based on the time spent out of course of the given year. That's going to vary, but it's a good way to contain everybody that's involved, that's touching the project. Contract research. Now, the U.S. government wanted this thing to originally to support W-2 jobs, to support permanent jobs. That was one of the main criteria and main focuses of the credit itself. But there's also the fact that the U.S. system relies on 1099 folks, contract workers, et cetera, et cetera. In addition, there's some things that people specialize in, and they come in on a one-time basis, on a one-off basis, provide the service, provide the expertise, and then they go away, right? And so with that being said, the government provided for 1099 folks and contract research expenses to be included in this, But they took a haircut. So if you notice on the slide, it says they'll be claimed at 65%, right? And that's just black letter law. There's no other analysis for it. If you're a contractor, or if you're on, paid on 1099, or you're an outside worker, you're not W-2, you're not a salary, you're going to get 65%. But often when you're consultative, those consultants aren't cheap, right? And so it's that 65% can run into money. Basic research paid to eligible institutions of higher education. This means when you're looking at certain projects and you're actually having to pull in and include folks from, let's say Harvard. I mean, we're here in Boston, right? Or Stanford on the West Coast, right? That is something that's going to cost you money as well. But it's also something that if it's involved with the research, that it has nexus with that research, you're going to look at it, and it's going to be able to be included under certain circumstances, obviously, which is one of the reasons that Leighton advises on this. Is there are a lot of options for us to pull in dollars, but they have to meet certain criteria. So that's kind of what Leighton's purpose is there. Materials and supplies. So, for example, I mentioned craft breweries earlier, right? Well, guess what? All of that stuff that they put into the boil to create the batch, that's essentially raw materials and supplies that are used or consumed in the process. Similarly, if you're a manufacturer and you're developing a prototype, and you actually have to take blocks of pressed aluminum, expensive blocks of pressed aluminum, and prototype them out. Well, guess what? What if that first one you run doesn't work? Are you stuck? No, yeah, you have to eat that cost. But that's what this part of the R&D tax credit is designed to do, is to allow you to reclaim that cost, allow you to reclaim it, and put it towards your tax credit. So that's a benefit there. So if you're developing, like I said, if you're prototyping or if you're using any kind of raw materials and supplies, those costs can be claimed as well. And that can often run into money depending on how your costs are allocated. Now, interestingly enough, we're talking about R&D. We're talking about developing a new product or new process, and that obviously leads to the patent side of things. Now, the patents are interesting because patents are pretty. There's a lot of requirements in a patent, right? There's an application that you have to have a write-up describing what it does, why it's different, why should you get to have the rights to it, and that's not cheap, and that's not easy. So interestingly enough, the IRS has provided for what they call the patent safe harbor rule, which means if you go back to our 4-part test with a patent, the IRS says you've already fulfilled the new or improved business component piece, you've already fulfilled the elimination of uncertainty piece, and you've already fulfilled the fact that there's a technological in nature piece, right? So the only thing you have to then prove is what kind of experimentation did you do. So that's one benefit. But additionally, as part of a cost category, you can also claim the legal fees associated with those filing patents, because essentially those are contractor costs that are necessary for you to file your patent to retain your intellectual property. So that's something that is going to be, and like I said, they're not cheap. So it's something to be aware of as well. So ultimately, let's not skip before they're too quick. So just to go over this again, real briefly, all these cost categories have to have what's called a nexus with the activities. So we have that 4-part test. We qualify the activities themselves, and then once those activities are qualified, well, all the costs that are related to it, the costs that if you did not have those activities, you would not have incurred those costs. All those costs can be claimed as listed here. All right. So how does the R&D credit benefit the subsidiary, especially in the U.S.? Well, we talked about payroll earlier. Payroll generates one of the first tax liabilities that you're going to experience, and that's going to be on a biweekly or monthly basis, depending on how you run payroll. And ultimately, if you're looking at it, you're going to be hiring the right people. You're going to be paying them significant sums, and that's going to run into money. So that's going to be a quick, easy cost that you're going to have to deal with on a regular basis. So the R&D credit defrays that. So ultimately, you're looking at taking the work you're doing already and recycling that money, recouping that money, if you will, and applying it to your operating costs. That's going to have an instant impact on your cash flow on a monthly or biweekly basis, right? So this brings up another aspect of the R&D the payroll tax credit that's valuable to consider. One is that you're looking at a 5-year payroll credit window. So this is a nuance of the payroll credit. which requires you to not only meet the 4-part test, but also be what we call a qualified small business. And a qualified small business refers to the fact that you're under $5 million in revenue per year, and you've only had revenue for 5 years or less. So as soon as you have $1 of revenue, of income, gross receipts, that's going to start your window, right? You're going to have five years from that point to claim this. Now, like I said, every time you claim it, the payroll credit does not expire, but it does give you that five-year window. So it's imperative that if you're in that window, or that you're about to be in that window, that you start claiming as soon as possible, because that clock stops for no one, right? There's another interesting aspect here, that the funding, that if it comes from the foreign parent company, if it is actually spent in the U.S. by the U.S. entity, that's still, the money then still flows back to the U.S. entity, right? Even though it's technically sourced from the foreign headquarters, if you will. If it is spent in the U.S. and it's spent by the U.S. entity, and that U.S. entity is tax paying, that's the money essentially goes back up and stops at the U.S. entity, at least in the IRS's view. So that's not a stopgap to claiming those costs there. And like we've been saying all morning, these credits can be built into a yearly financial plan, right? It's permanent. It's something that is valuable to look at and continue claiming, and to kind of build on itself. For example, let's say you generate $100,000 in tax credit in year 1, and then $250,000 in tax credit in year 2, but you only used 75 grand of it. Well, now you're building essentially a pool of money to defray your costs well into the future. So it just kind of gives you a chance to build on it, to develop it, to bank it, if you will, and affect your financial well-being. And like I mentioned earlier, that demonstrates fiscal responsibility, right? And you're not having to give away any percentage of your business to a foreign, it's not a foreign, but an outside entity. You're recycling your own costs, right? And that's kind of it for us this morning. I'm going to open it up to questions. Joan?
Yep. Hi, everybody. Please do enter any of the questions that you have as a participant in the chat box, but I have a couple for you, David, Craig. First of all, for startups, if a startup as 1, as 2, as 3, is there a minimum number of team members in your startup company that you need to be able to apply for this? A sole proprietor is doing R&D in software. What are the eligibility requirements that way?
So ultimately, there's no arbitrary number limit on folks that are involved in this for them to claim the R&D credit. The one issue that I would say with a sole proprietor is likely not going to have as much payroll, right? Maybe not even have a payroll. But he can still claim the credit against costs on his or her Schedule C on a 1040. So it's just a matter of understanding the corporate structure, where the costs are, and where things can be claimed. As soon as that sole proprietor has a W-2 payroll, then he or she can claim those costs against whatever that payroll tax credit is. But there's no arbitrary limit to number of folks. There's actually no arbitrary limit to number of dollars that can be claimed, as provided that they meet the 4-part test.
Great, thanks. Just a couple of questions. When you were looking for your first offices in the U.S., Boston, why Boston?
Handle that one.
The big draw for us was around the kind of the tech hubs. So a couple of factors we considered, obviously where a good local network of good technical businesses sat. So California and Massachusetts have kind of always been very comparable when it comes to levels of innovation. So we thought that'd be a good spot for us to drop anchor. The other element as well was obviously the locality to Europe being important. Certainly for the initial year or two, where we've even now we still do have a lot of dialogue backwards and forwards with group in Europe, and being in Boston gave us good half day to connect with the European offices. Obviously, anything further west, we start to lose a lot of time. In some areas, potentially a whole working day is gone. So we were keen to get somewhere on the East Coast and also somewhere with a good technology hub as well.
Yeah, and then a little follow up to that. What do you attribute your rapid growth in the U.S. to? You're not in business for that long, but you've really, got a good team. And how have you grown so fast?
I mean, we've been given a very good backing from the group to grow. We have brought on a lot of sales roles, so we've got a lot of access to the market that way. So just getting feet on the ground and essentially getting to companies first. As David alluded to, R&D tax credits is not on everyone's radar. And so a lot of it really is getting hold of companies, educating them on what the credit is, and I guess convincing them that they are able to qualify and they are able to get a good credit back. And quite often the process is quite organic, so it'll be something which their CPA might mention in passing, or something they stumble upon Googling it, or whatever it might be. So Leighton's always had quite a sales-focused approach, where we look to try and get there first and speak to these companies first about the credit before it kind of gets onto the radar of their CPA or CFO. So I think that approach has been important, but ultimately I think we've had to adapt very quickly. We've brought on a lot of good talent who have experience in the market. So people like David, who have had audit experience and R&D tax experience. That's been really important, so that we can quickly, grow our expertise and prove to our clients that we're able to do the job here. Without that, it would have been very difficult. So getting the right foundations in terms of the right tax and technical people, but also that investment in sales has been a big driver for our growth in the US.
Yeah, especially since I think you mentioned early on in the presentation, there was something like 65% of companies don't know about it or take advantage of it. So there's quite a good market there for you, right? As you approach these even early stage companies. Here's a question here. If my R&D tax credit exceeds my income tax liability, can I carry the credit forward, and for how many years?
Yeah, sure. As far as the R&D credit's concerned, there's actually two options you can do. You have 1 year carry back in case, in the event that, let's say your 2020 tax credit was in excess of your 2020 tax liability. You can then carry it back 1 year to 2019. And you can also carry it forward for 20 years. That's on the federal level. The states themselves generally have different carry forward provisions. But yes, you can carry it forward. You don't lose it. Obviously, I suppose you would lose it at 20 years later, but you don't lose it just because you can't use it.
Yep. Here's another question. Are tax credits, current and forwarded, still available in an M&A to make an M&A of a U.S. company more attractive to a foreign buyer?
So the interesting thing there is with an M&A, you're looking at a situation where somebody is going to be subsumed to the other, right? It's either going to be a merger and there's going to be creation of a new business, or there's going to be an acquisition where one company takes over the other one, right? And the interesting thing about the R&D tax credit is that, as like with other tax credits, it tracks to the FEIN, the federal tax number of the company, of the U.S. entity. So in this instance, if you're looking at let's say a French entity and a U.S. entity, and the U.S. entity has X number of dollars credits, let's say $2 million in credits, just to use a large example, that may be something to consider as to which company takes precedence in a merger, because what will happen is if that U.S. FEIN is dissolved, the credit's dissolved. So that's something to evaluate as to if should I subsume my other M&A or my other entity to the U.S. entity in order to maintain this value. So having that value on the books can be important for the U.S. entity, but it's important to remember that it does track directly to the U.S. tax number for that company. So in the instance that you're looking at a merger, if that U.S. entity dissolves, that credit dissolves too.
Okay. How about for a early stage company that's coming to the US, but their US work isn't well documented? Is that going to be a problem in applying for this?
Go ahead.
Yeah, go ahead.
Okay,
You know,
so the IRS,
they didn't know about this. They didn't know what they needed to document. Is it still available? Is there a way to, you know, work around that?
sure. So the IRS has no particular documentation restrictions or requirements, which is kind of good and a bad thing. It means that you don't really have a lot of guidance, but it also means you're not necessarily limited in the instance where you have, you know, less than quality documentation. Obviously, the better documented the activities are, the more beneficial that is. And Leighton has developed a process of working with our clients to sort of, you know, evaluate and consolidate and prepare to present the available documentation in its best form, but also to provide, you know, guidance on, you know, future years. Here's how to do it a little bit better in the future, right? But ultimately, if there is a situation where there's, you know, limited documentation or, you know, less than perfect documentation, that's not necessarily a deal breaker. It's just something that, you know, that we'll have to work around. And as far as Leighton's concerned, what we do is we actually prepare a substantiating report derived from documentation. If there's, you know, or even just from discussions and interviews with the clientele. Obviously, there does need to be some sort of contemporaneous documentation. That's the IRS term. Contemporaneous documentation to kind of track, you know, hey, who, you know, did Bob do this or did Sarah do this, right? So there does need to be something, but you'd be surprised at the what we can work with. You'd be surprised. And of course, you know, how we also would recommend, you know, certain processes to improve that going on a go-forward basis.
And how would a foreign company with a U.S. entity start to engage with you? And consult with you on whether, number one, they're qualified as a small business to do this, and sort of what the timeline is in the tax year? When does this all get started? Probably the sooner the better, but what's your advice on that? So would a company how do you start to engage with a company? They would give you a call, set up a time for a consultation. Is there a fee for the consultation? What is your fee structure in working with startups? Just sort of give an example of how a early stage company would start to work with you.
Tom, you want to handle that?
Certainly. So one of the big blockers to the credit is understanding whether you qualify for R&D, and secondly, how you're going to benefit from the credit. So these are a couple of things that are important that we establish before we start moving into the full process, because what we don't want to do is go through a full application and at the end of it establish that the credit is a lot lower than they were hoping for, or the way they're going to receive the benefit is not as expected. So we need to do quite a bit of due diligence up front to make sure that this is worth it for both parties. So typically we'll commit to, you know, a 30-minute discussion, typically 35, 45 minutes. And we'll go through, you know, tax returns, we'll go through high-level projects and better understand the intricacies of whether they're going to benefit and how they're going to benefit. If at that point we find that it's going to be very limited in terms of the quantum of R&D they're spending, or that their benefit is not going to, you know, be as expected because of their tax position, at that point we can really just stop the process and perhaps re-engage in a year's time, and there'll be no fee for that. Where we do find R&D and where we see that there's a benefit that's going to be attainable, we go through the process and we take a percentage of that credit amount, which is typically around about 25%. So we've really designed it to mitigate risk from our clients, but also from ourselves as well, because it's in no one's interest to spend several hours or days on a credit that no one's really going to benefit from. So really important that we're putting that upfront resource in place to give people peace of mind that this is worthwhile doing.
Okay.
And speaking of peace of mind, Joan, sorry to interrupt real quick, but as part of that agreement and service package, if you will, we do stand behind our work, and there is we do include a portion of audit defense hours in the unlikely event that an IRS agent does come knocking. I personally have handled about 40 or 45 audits And so if anybody does come knocking, my team and I put on our legal hats and we go to battle for the client. So basically the idea there is, like, as Tom mentioned, mitigate risk and cover everybody from A to Z.
Great. I have one more question, probably time for 2 more questions here. Let's see here. Can a contract R&D firm take advantage of an R&D tax credit for their expenses if their clients don't, or even do, take advantage of the credit for the contracted work? Want me to read that again? I have to think. Can a contract?
Yeah, that'd be great to read it again.
Yeah, can a contract R&D firm take advantage of an R&D tax credit for their expenses if their clients don't, or even if they do, take advantage of the credit for the contracted work? So that's the client and the company that's working for them, I presume. Can they both file for an R&D tax credit?
Right. So the interesting thing about contract research is that there is a secondary legal test, a legal analysis that has to go into, that has to be analyzed to qualify the activity and who gets to claim it. So in the instance of a situation, and that's economic risk and retention of rights. So in the event that somebody is being paid on a T&M basis, a time and materials basis, well, guess what? They're not the people that are getting paid are not going to have any economic risk, because what's happening is they can bill X number of hours and they're going to get paid for it. Whereas on the other side, the person that is paying them is technically at risk because of the fact that if they run those hours up, they're on the hook, right? Now the reverse is also true in the instance where someone is paying a contract R&D firm, as you mentioned, is paying them on a fixed fee basis. Well, in that instance, the payor is getting a fixed fee. They know what to budget for. There's no risk there. They know they're going to get paid $100,000 and that's it. Whereas the contract researcher, in this instance, getting paid that fixed fee, is on the hook to deliver what's agreed upon. And if they have to spend more hours, that they're still only getting 100 grand. So that's kind of the analysis that we would go into with a contract firm. Typically, and that would kind of decide who gets what, right? As to how the contracts themselves are structured. In the instance that there is a sort of an experts for hire scenario, so say a company, the contract research firms, sends an engineer in on a hourly basis to the client. Well, in that instance, that's sort of an expert for hire. That's not, they're not retaining the rights to their research, right? Because they're essentially doing the work that for that other company. That other company would be able to claim those contract costs as R&D expenses, but the experts for hire or contract research firm would not be able to. So it's really, there's a deeper analysis that has to go on there, but and the answer is it depends, right? Not the most helpful of answers, but that's also something that we're happy to do as part of our evaluation.
Okay, just a couple more here real quickly. We started late, so I'll go over a minute late. Will this tax break cover R&D that is contracted with foreign institutions?
So this is
and then another question from the same attendee is, do you have offices in South America?
I'll answer the first part, and then Tom, you can answer the second part. As far as foreign companies go, this is a U.S. credit. This is a federal credit, right? And so if you're contracting with a foreign company, unfortunately, that's likely not going to qualify. The one difference is if there's a software analysis or a software aspect of this, and the U.S. entity is contracting with a U.S. staffing firm, which is then paying overseas folks to get on the VPN and do the programming and do the coding and so on and so forth. That is one workaround as far as the costing goes. But obviously, if the work is being done in South America in this instance, or in any country outside the U.S., it is outside the scope and is excluded from the credit. Tom, I'm not sure about the South America piece.
Yeah, so the simple answer for that is no, we don't currently have an office in South America. I know it's something which is being looked at the moment by the group, but at this point in time, we don't have an office there.
And on your final slide here, you list all these countries on the bottom of the slide. So those are countries that you're working with now? Is that Okay.
Yeah, they're all the countries where we currently have an office, all are serving that market.
And one last piece here. Since IP legal fees can be included in R&D tax credits, can latent fees also be included?
Unfortunately not, because basically this is the latent fees are going towards the credit analysis, right? It's not really contributing to the actual work itself. It's contributing to the analysis of the work. So I would not recommend including our fees.
Okay, great. I think we're going to have to end it there. But just in parting, I just want to make sure that any of you on the call know about our next webinar, which is scheduled for Tuesday, June 9th, again, 9 to 10 a.m. Eastern Time. And the topic will be how investors are using revenue-based financing as an alternative model for funding startups. It will be presented by an angel investor with Walnut Ventures, Ben Littauer. So we hope you can join us then. You can go to our website to register for that if you're interested. So thank you, everyone. We appreciate your time this morning, and I'm sure you learned a lot.
Thank you, Joan. Thanks, everyone. Please reach out to us via email if you have any questions.
Thanks, Jane. Thank you, guys.
Thank you, everyone. Have a great day.
Thanks. Bye-bye.